We are now on week 4 to 5, unit 2. At the end of the unit, you are expected to demonstrate mastery on rules of estate and trust taxation, demonstrate mastery on rules of partnership taxation, and master the components of gross income. Now, under the unit learning outcome A, you have to demonstrate mastery on rules of estate and trust taxation. So what is estate? An estate refers to all the properties, rights, and obligations of a person which are not extinguished by his death, and also those which have accrued thereto since the opening of the succession. So, an estate is basically the assets and the liabilities of a person that remains or that are not extinguished by reason of his death. And of course, those assets may be or those properties may be earning income. And if it earns income, then it has to pay income tax. Now, before we dig in as to how estates are being taxed, let's first know when an estate should be taxed. So, an estate is an income taxpayer if under judicial settlement or administration. So, we have two types of settling estate. First, you have judicial and you have the extrajudicial. So, a judicial settlement happens when, for instance, the deceased person was not able to make or to write a last will and testament as to how his or her estate will be divided upon his death. Okay? So, if in that case, the estate of such a deceased person will be administered or will be settled in the court. If it is settled under an extrajudicial settlement, or if it is settled extrajudicially, then it happens when a deceased person is able to write a last will and testament with regards to how his or her estate will be distributed upon his or her death. So only in the case of a judicial settlement or administration that estates earning income will be taxable. The second one is trust. So trust is an agreement created by will or an agreement under which title or property is passed to another for conservation or investment with the income therefrom and ultimately the corpus or principal to be distributed in accordance with the directives of the creator as expressed in governing instrument. So basically a trust, there is this what we call a grantor and a trustee and the beneficiary. So basically, a grantor having properties would transfer the administration of such property to a trustee. For what purposes? For investment or for conservation. When you say investment, of course, in order for such property to earn income and ultimately direct the trustee or the fiduciary of such property under trust as to how such income will be distributed. So, a taxable trust, to be taxable, must be irrevocable. So, only those trusts that are irrevocable must be taxable. So, when you say irrevocable, the ownership of such property when it is under trust will not revert to the grantor or to the original owner of the property, or in this case to the trustor or grantor. But if the trust is revocable, then it is not taxable. It is not a taxable trust because the ownership will revert to the trustor or to the grantor in some future time. So again, only irrevocable trust or those trusts where ownership of the property under trust will not revert to the trustor or grantor. Beneficiary. It is the person whose benefit the trust has been created. So basically, whatever the fruits of the trust will inure to the beneficiary or will go to the beneficiary. A beneficiary has equitable title to the property transferred to the trust, including generally the possession and use of the property. Now, a fiduciary is the general term which applies to all persons or corporations that occupy possession of peculiar confidence towards others, such as trustees, executors, guardians, or administrators. So basically, trustees, executors, guardians, or administrators are fiduciary in an estate or in a trust agreement. Now, taxable estates and trusts. So, taxed in the same manner and on the same basis as in the case of individual. So, again, the income of estates and trusts will be taxed on the same basis as in the case of individual taxpayer. So, they follow the same rule, particularly in using the in using the graduated tax table under section 24A of the tax code. Allow deductions. Amount distributed to beneficiaries. So, if the income of a trust or a portion of the income of a trust is distributed to the beneficiaries, then it shall be deductible from the income of the trust subject to tax. Next, amount collected by guardian to be held or distributed as the court may direct. So whatever amount of the income of the property distributed to the beneficiary or to the guardian of the beneficiary shall be unallowed deductions to the income subject to tax of estates and trusts. Income of a trust will be taxed too. Depends if the trust is revocable, meaning the ownership of the property and the trust will revert to the owner or to the trustor or grantor, then the income of the trust will be taxed to the trustor. Now, if the income or if the trust agreement is irrevocable, meaning the ownership of the property under trust will not revert to the trustee or will not revert to the trustor, then the income of such trust is taxed to the trustee or the administrator of the trust or of the property under trust. Estate as a taxpayer. An estate is a taxpayer if it is under settlement or administration. Trust as a taxpayer. A trust is a taxpayer if under the terms of the trust, the fiduciary must accumulate the income or the fiduciary may accumulate or distribute the income in his discretion or in the discretion of the fiduciary. So in these cases, a trust is a or will be a taxpayer. Now, when is the income of the trust taxable to the grantor? If under the term of the trust, the title to any part of corpus or principal of the trust may be revested to the grantor, the income of the part of the corpus or principal shall be taxable to the grantor. So, whatever income of the corpus or principal of the trust that will revert to the grantor shall be at the same time taxable to the grantor. So if the grantor receives a portion of the income of the corpus or of the principal, then such income received by the grantor is taxable to the grantor or to the original owner. If under the terms of the trust, the income of the trust shall be applied for the benefit of the grantor, the income that shall be applied for the benefit of the grantor shall be taxable to the grantor. So the same case in number 1. In number 2, if an income of a trust is applied to the benefit of the grantor, then such income applied to the benefit of the grantor will be taxable to the grantor. For example, si grantor may utang. Tapos, si grantor may trust. Let's say, irrevocable trust. So, per se, yung income ng trust na yun, because it is irrevocable, then it is not taxable to the grantor. But it is taxable to the trustee or the fiduciary. However, if there is an agreement that a portion of the income of the property under trust will be paid or will be used for the benefit or for the payment of the obligation or the liability of the grantor to a third person, then such portion of the income applied for the benefit, in this case for the payment of the liability of the grantor to a third person, such portion used or payment for his benefit will be taxable to him or to the grantor. Treatment of income distribution of the year's income to heir or beneficiary. When an estate of a trust is a taxpayer, a distribution of the year's income to an heir or beneficiary is a special item of deduction to the estate or trust and a special item of income to the heir or beneficiary. So basically, if a portion of the income during the year of the trust or of the property under trust or of an estate is used or is distributed to the heir or to the beneficiary in the case of trust, then such income or portion of the income distributed to the heir or to the trust is a special item of deduction to the estate or trust. And such also a distribution received by the heir in the case of estate and beneficiary in the case of trust is a special item of income to the heir or beneficiary. Of course, your heir at the end of the year or at the end of the taxable year will have to file an income tax. So whatever he or she receives from the estate or from the trust will be declared by such heir as a special item of income, which is in return will be subjected to income tax. Computation of taxable income of estate and trust. So gross income, that's gross sales minus cost of sales or cost of service. That's gross income less deductions, business which are business expenses. So you get the taxable net income. So the taxable net income will be the basis for your tax due based on the section 24A, the same as taxation on individual taxpayer. Now, personal exemption of 20,000 pesos for estates and trusts has been amended by Train Law. So it is completely deleted under Train Law. Several trusts with a common grantor and a common beneficiary. So if there are more than one trust with common grantor and a common beneficiary, here are the rules on how to file. Filing of separate return. So a separate return will have to be filed for each trust by the respective trustee or fiduciary. For example, si grantor, may lupa siya na iba yung trustee, tapos may building siya na iba rin yung trustee, then each trustee will have to file a separate returns. So magpa-file si trustee sa lupa ng income tax return, pati na rin si trustee sa building ng income tax return. Consolidation of the separate return. So at the end of the year, after filing a separate return, then all the trusts will be, or all the trusts with the same grantor will be consolidated. Consolidated income tax. So an income tax shall be computed on the consolidated income. So at the end of the taxable year, or upon filing, all the gross income or the gross income of all the trusts or estate of the grantor, of the same grantor, will be consolidated to compute for a consolidated income tax. So the tax computed on the consolidated income shall be apportioned to the different trusts, such that each trust shall have a share in the income tax on consolidated income. So, for example, kanina, may income si land, tapos nag-file ng separate income tax si trustee sa land, tapos may income si building, tapos nag-file ng separate income tax si trustee ng building, pero yung grantor nga nila isa lang, so kailangan yun i-consolidate. After consolidating, of course, you will compute the taxable income and the corresponding income tax due. And the income tax due will be apportioned to the separate trusts. So how? How to compute the portion allocated to each trust? So here's the pro forma computation. Taxable income of the trust less taxable income of all trusts times consolidated income tax. Then you get that trust's share of the income tax. So each trust shall pay an income tax still due computed as follows. So income tax apportioned to the trust. So ito yon. So income tax apportioned to the trust less income tax paid by the fiduciary of the trust. So kahit na may apportioned income tax si trust, tapos may nabayaran na siya, kailangan lang niya i-deduct or i-less sa portion, i-less niya yung nabayaran na niya na income tax sa portion or sa share niya sa consolidated income tax. So, ito yon. Okay, the graduated income tax table, the same as the graduated income tax table used for individual taxation. Now, to apply or to illustrate the theories that we discussed above, here's illustration 1. The estate of Mr. Indiano has 800,000 pesos gross income before business expenses of 200,000. The estate administrator distributed 300,000 to the heirs in accordance with the will of Mr. Indiano. The taxable income and tax due will be computed as follows. To compute gross income of the estate, 800,000 less the business expenses of 200,000 pesos or 200,000 less the 300,000 special deduction or special item of deduction, which is the amount distributed to the heirs. So the total deduction is 500,000. 800,000 minus 500,000, then your taxable income is 300,000. So to compute the tax due, you refer to the graduated income tax table. So the first 250,000 is tax exempt. The excess of 50,000 over 250,000, kasi nga 300,000 yung taxable income natin, kaya 50,000 yung taxable lang, times 20%, that's 10,000 tax due. Illustration number 2. Kevin, designated, in irrevocable, therefore taxable to kasi nga irrevocable trust, a property in favor of J and appointed kay J as trustee. So basically, si Kevin yung may property. Yung property niya, designate niya as irrevocable trust. Yung nag-administer or yung trustee or the fiduciary is KJ. Para daw in favor of J. So maybe in the future, based on the directives of Kevin, yung property will become the property or will be that in favor of J. So the property earned 1,500,000 income before expenses of 200,000 and trust fees of 50,000. In accordance with the trust indenture, KJ distributed 100,000 to J. So in this case, si KJ daw as the trustee or as the fiduciary distributed 100,000 to J based on the directives or the trust indenture by Kevin. So the taxable income and tax due will be computed as follows. 1,500,000 na gross income less allowable deductions. You have expenses or business expenses 200,000 less of course your trust fee 50,000 and less again a special item of deduction distribution of 100,000 to the beneficiary or in this case to J 100,000. Therefore, the allowable deduction is 350,000. So 1,500,000 minus 350,000, you get 1,150,000. To compute the tax due, you refer again to the tax table. 1,150,000 belongs to 800,000 to 2 million, where 130,000 plus 30% of the excess over 800,000 will be the tax due. So in this case, 800,000 is 130,000 tax due plus the excess of 800,000 to 1,150,000, which is 350,000 times 30%, that's 105,000. You add, the tax due is 235,000 pesos. Now, let's discuss the consolidation or what will happen when a consolidated return or income tax return for trusts happens. So, in this discussion, we will apply the rules on how to apportion the consolidated income tax to each trust. So, illustration 3. Don Jose designated 3 trusts, all in favor of his son Joe. So, in this case, one of the rules or the rules in order for a trust to be consolidated is that there should be the same grantor. In this case, the grantor is Don Jose. And there should be the same beneficiary. In this case, the beneficiary is the son of Don Jose, which is Joe. It doesn't matter if there are different trustees. So, here are the trusts. Trust 1, 2, and 3. Now, you have to determine the designation of each trust because only the irrevocable trusts is subject to tax or taxable to the trustee. So in this case, only trust 1 and 2 is taxable to the trustee. The income of trust 1 is 300,000 and the income of tax 2 is 400,000. The income of trust 1, which is 300,000, have a distribution of 30,000 to Joe. Okay? Or a portion of the 300,000, which is 30,000, was distributed to Joe. And the portion of the 400,000 income of trust 2, which is 40,000, was also distributed to Joe. Remember that a distribution to the beneficiary is a deduction in computing the taxable income of each trust. So for purposes of income taxation, the income of Trust 1 and Trust 2 will be consolidated. Consolidated because there is the same grantor and there is the same beneficiary. So to compute the operating income, to consolidate the income of Trust 1 and Trust 2, that's gross income 300,000 of Trust 1 plus gross income of 400,000 of Trust 2, that's 700,000 less allowable deduction, which are the distributions to the heirs, 30,000 plus 40,000, that's 70,000. Therefore, the taxable income is 630,000 pesos. To compute the tax due, refer to Section 24A. The tax due as computed is 87,500 pesos. The tax due will be again the 87,500 pesos is the consolidated income tax of all the trust. Again, it has to be apportioned for Trust 1 and Trust 2. How to apportion? Let's go back to the computation or the formula for the apportionment of the consolidated income tax, which is the taxable income of the trust of Trust 1 or of Trust 2 divided by the taxable income of all trusts. So in the example, the taxable income of both Trust 1 and Trust 2 times the consolidated income tax. So in our case, or in the case of our illustration, the amount that will appear here, that should appear here, is the 87,500. So let's go back to the illustration. So tax due will be apportioned to Trust 1 and Trust 2 as follows. 270,000 divided by 630,000 times 87,500 equals 37,500, and 360,000 divided by 630,000 times 87,500 consolidated income tax equals 50,000. Again, the total is 87,500. Now, how do we get, or how did we arrive at 270,000 and 360,000? Remember that both of these are the taxable income of the trusts. The 270,000 is the taxable income of Trust 1. How do you arrive with 270,000? That's 300,000 income less the distribution of 30,000. Therefore, we get 270. The 400 or the 360,000 is arrived at or by deducting that's 400,000 minus 40,000. This should be 40,000. So this is just a typo error. So this should be 40,000, which is the distribution to Joe. 40,000, that's 400,000 minus 40,000, that's 360,000. So you add 270,000 taxable income of Trust 1 plus 360,000 taxable income of Trust 2, you will arrive at the taxable income of all the trust, which is 630,000. This will be now your denominator. 630,000. So in this case, 270 divide 630 and 360 divide 630,000 pesos. Note, Trust 3 or number 3 is not taxable as it is a revocable. So it is taxable to the grantor. So the entire 530,000 of trustee, including the 50,000 income distribution, will be included in the taxable income of Don Jose. Kasi nga, it is revocable. Again, a revocable trust or the income of the revocable trust will be taxable to the grantor. In this case, the grantor is Don Jose. Therefore, the 500,000 and the distribution of 50,000 or including the 50,000 income distribution will be taxable to the grantor or Don Jose. So you can also refer to some sources. You have Ampungan, Balyada, and Valencia. So they have available books that you can refer to. Okay, so that ends our discussion for income taxation of estate and trust. Peace.